Howdy, Jacob here. Today we're looking at the Williams companies. We'll say it's the start of a big earnings week, so stock market should be a fun one. 5.1% yield for the Williams company, $42.4 billion market cap on $63.1 billion enterprise value. So good amount of net debt here. Huge company, I don't believe I've heard of before. So it's always cool to see companies you may not have heard of that are as big as they are. And 1908 was when it was founded. We see that their revenue has grown from 6.8 billion in 2013 to 10.9 billion in 2022. That's mostly a large 37% revenue increase in 2021. Return on invested capital very poor, low single digits. That's why it's good to see them pay a lot of their cash flow and dividend. Now let's see how much. So their dividend payout of 2.1 billion for their dividend, and that's about a 5-year average of probably no more than 2 billion. And so on a 5-year average basis, they're paying out everything they have in the dividend. And it looks like their other uses of cash are a bit on acquisitions, and then looks like they issue a little bit of shares, issue a little debt for the most part. So majority of their cash flow goes towards dividends and then a bit towards acquisitions. And then their balance sheet, let's see what that net debt looks like. So 21.9, essentially 22 billion on long-term debt, about a billion short-term debt, and only 152 million cash on hand. So not the most liquid balance sheet. And we said that their 5-year average free cash flow is about 2 billion, and this is over 10 times that. So that's definitely not what you want to see for a balance sheet. I would not consider this a safe balance sheet company, but I think we can get ready to make some assumptions here. I think that their growth is going to be coming pretty heavily from acquisitions, and so maybe they grow 3%, but I don't think that they deserve any sort of premium on the P and price to free cash flow. And so I put them even at 10, saying that they might have growth ahead of them through purchasing companies, but not much through organic. And then on the margin side, if we look at averages 12 and 17, I do like that free cash flow is consistently higher, but they do have a lot of debt. And so a 2% increase to their debt would probably be paying out about 400 million more dollars. So that was just 2 billion times, or the roughly 20 billion, let's say, in debt. 2% of that is about 400 million, and 400 million in relation to their 5-year average of, let's say, 2 billion is a good amount. It's about 20%. So there could be a 20% hit to margins if there is a 2% bump to their debt and they're not aggressively paying that down. And so I will lower the average margin or the expected margin from average. Maybe let's go 11 and 15. Oops, wrong spot. And then for share change, relatively flat. Let's just assume no change. Their dividend, I said that they're paying out almost 100%. And so to me, actually, let's divide it by 2, because I really don't like when companies are paying out more than 50% they're unless they have extremely consistent free cash flows and they don't have a lot of growth out of them. Here we don't have a lot of growth, but I don't think their balance sheet suggests that they can do this, as their liquidity is pretty low in comparison to debt, and then also their their payout is a bit too high, and they pay a bit for acquisitions and such. So I try to balance out what I want the company to do with what they've done in the history, and so I see that they use a lot of cash flow for acquisitions as well, and so I don't think this company should have as high as a 70% payout without issuing more debt or issuing more shares, which you definitely don't want the company to do, especially in this situation. So for me, it's really not not looking very close to a price that I would want to purchase it at. We're saying that the company's stock price would have to fall 73% to get a 15% return, given these assumptions. As for the dividend yield portion of it, we're saying that it does have a 5.1% yield right now, but their payout on a 5 year average basis is nearly 100%, which is not lastable. It's not long lasting, especially when your balance sheet does not have a plethora of cash on hand to help pay towards a dividend until the free cash flow comes up, which we're just not seeing. And so to me, I think that they'd have to cut this dividend. And to me, their balance sheet's just not super attractive. And so I would wait off on the company right now. Thank you and have a great rest of your day.